Hello, my name is Brenton Harrison of New Money, New Problems, and we're here today to talk about a technique that more and more homeowners are utilizing to try to save money on their monthly payments and also save money on their mortgage interest rate. It's called using discount points to buy down your mortgage, and we're going to talk about the pros and cons of it right now. Let's get started. I was fortunate enough to be able to buy my current home in late 2020 when interest rates on home loans were really low. And when the values of the homes in my neighborhood started to increase along with these interest rates that you're seeing because of inflation, I realized it's highly possible that some of the new people moving into my neighborhood could be paying like $2,000 more per month than I'm paying for the same type of home. And in trying to avoid these interest rate increases, you're starting to see more and more home buyers who are looking for ways to cut costs. And we've covered some of those ways before. We did a video on adjustable rate mortgages, which if you haven't checked it out, you should go check it out now and come back. And when you come back, I want to cover a popular strategy in addition to adjustable rate mortgages that people are starting to use, and that's using discounted points to buy down your mortgage rate. So first, what is a discount point? Well, a point equals 1% of the loan balance for a mortgage. For this post, we're going to be using a $300,000 home loan to illustrate certain concepts. So 1 point would equal $3,000, $300,000 home loan times 1% interest. A discount point is something that allows these potential homeowners to pay an upfront fee in exchange for their lender lowering their interest rate. So these discount points are paid at closing, so it increases the cost that this homeowner has to pay when they get to the table to actually sign on the dotted line. And these discounted points, if you are going and you're considering it, even before you close, your lender has to give you a loan estimate that tells you the interest rate, it tells you the payment. And if you're using discounted points to potentially buy down the interest rate, they have to show you those points on that loan estimate. And they do the same thing when you get to your closing disclosure. And a good lender should walk you through the difference between you having a mortgage that you have bought down with discount points versus the cost in the long run of you having what's called a 0-point mortgage. And a 0-point mortgage is simply a mortgage that you are not using discount points to buy down the rate. But even if your lender does walk you through some of the differences between a 0-point mortgage and one that you have bought down with discount points, it's really easy to fall into the trap of just seeing that lower payment and assuming that it's the right thing to do. Now, the amount that it lowers in terms of your payment really depends on a number of factors. It could change based on your specific lender. It could change based on just general market moves and also the type of loan product you're using. But we want to make sure we give you these pros and cons so you know exactly when it's the right or the wrong thing for you to do as you proceed in your home search. To start peeling back the layers of whether a discount point is a good idea, you got to first understand a concept called amortization. And amortization is defined as the action or process of reducing or paying off a debt with regular payments. And in layman's terms, that just means when you take out a mortgage, you are amortizing that mortgage loan over a predetermined length of time, 10, 15, 20, 30 years, by making a fixed monthly payment. The payment doesn't change. Whatever payment you have is designed to pay off that loan in full in the given repayment period. And when you're amortizing a loan, there are two variables that determine what that fixed payment will be. And those variables are the loan's interest rate and the repayment period. These are the things that dictate that monthly payment that will be needed to make sure that at the end of 10, 20, 30 years, that balance is $0. And early in the repayment process, that monthly payment will primarily just cover the interest. When you first get a home loan, almost none of your money is going to the principal. But with each passing month, the interest rate stays the same. And because your loan principal is reducing a little bit, that interest is accruing off of a smaller and smaller number. So every time you make a fixed payment from month to month to month, a smaller portion is going to interest and an increasing portion is going to actually pay down that loan balance. So for illustration purposes, I've gone to a well-known site, bankrate.com, to calculate what the monthly payment would be for a $300,000 home loan at 4.25%. I want you to see this in action so you can see the loan amount on the left, Loan term, 30 years, interest rate 4.25%. We're going to start these payments in August of 2022. And you can see that this leads to a payment of $1,476. So you have the $300,000 principal, and this payment of $1,476 is what's needed to pay off this balance in full by the end of the 30-year repayment period. Now you can also see that at 4.25%, it's actually going to take you $531,295 worth of payments to pay off what started as a $300,000 loan. And this total payoff amount, which far exceeds the original loan balance, is what can make buying down your mortgage rate using discount points look like a really attractive option. Why? Because even a seemingly small decrease in the loan interest rate can lead to a significant reduction in the total cost of the loan. As a matter of fact, if we use this same $300,000 principal for the loan and we lower the rate from 4.25 down to 4%, you can see that the total loan cost is now $515,609, which is a savings of around $15,000 over the course of 30 years. Now, one would then think that the only determining factor in choosing to buy down your mortgage rate is whether that total payment that you've paid towards the higher interest loan exceeds the costs of buying down to the lower rate. So using our example with this logic, any cost that you use to buy down the rate to 4% should be worth it as long as it's less than that extra $15,000 that's needed to pay off this loan at 4.25%. But it's actually a more involved decision than that. And in order to know what's best for you, you have to consider a couple things. The first is the time value of money, and the second is the break-even point. And the last thing that you're going to need to know is how to read something called an amortization table. But let's start with the two variables. So according to Investopedia, the time value of money is the concept that a sum of money that is given to you now is worth more than if that same sum were to be given to you at a future date. And the reason is due to that money's earning potential. Simply put, if I give you $15,000 today, it's more valuable than me giving you that same money 5 years from now, due to the fact that me handing it over now allows you to put it to use and hopefully let it grow. And when you're estimating to what amount this money can grow, if you were to get it now and invest those proceeds, there are calculations that you can use to determine what's called its future value. So we use a calculator at calculator.net to determine the future value of a $10,000 sum if it were to earn a 4% return over a 30-year period. Now you can see that by the end of the 30th year, the future value of that $10,000 sum is $32,433. So that's a gain of just over $22,000 from our initial sum. Now, the example that we've been covering for our mortgage calculations, $300,000 of a home loan at 4.25%, or that same loan amount at 4%, that led to a difference in total repayment cost of just over $15,000. So let's say our potential homeowner was offered the opportunity to buy down their rate to 4%, and it was going to cost them $10,000. Well, they might think they're making the right decision. I pay $10,000 to save money on this interest rate, and it's going to cost me $15,000 less to pay off this mortgage over the course of the loan. But in doing so, our future value calculator suggests they'd actually be sacrificing over $22,000 in potential market gains, even using a conservative interest rate. So our homeowner has to consider what they value more when they're making this decision, and they can gather even more information prior to making that decision by using an amortization schedule to discover the second variable. The break-even point is basically the month where you first experience the financial benefit of paying down this interest rate. And in illustrating this point, I want to assume that our homeowner who's buying this $300,000 home decides that they're going to pay 2 points to buy down their rate from 4.25% to 4%. Remember that one discount point equals a percentage of that loan value. So 2 points on a $300,000 home loan means it's going to cost them an additional $6,000 to go from 4.25% down to 4%. And there are multiple ways to look at the break-even point. Some people consider the break-even point the first month that the savings from their lower payment at the lower interest rate exceed the costs that they paid in discount points. Now that's a mouthful, so I'll give you a math example. If I paid $6,000 in points to buy it down and I'm saving $100 a month, my break-even point would be my 61st month, because that would be the first month that the total payment savings that I benefited from by having that payment that's $100 lower exceeded the $6,000 that I paid to get that lower payment. There are other people who are going to look at our example and they're going to look at the break-even point differently. They're going to say that the break-even point is the date that the mortgage balance of the 4% loan is at least $6,000 lower than what the balance of the 4.25% loan would have been in the same month. Now, this is a lot harder to calculate. And while there are lenders who will calculate that break-even point for you, it's best if you actually know how to read and understand an amortization schedule so you can find that date for yourself. And an amortization schedule is a table that shows the month-to-month effects of your mortgage payment in terms of the interest that's accruing, the principal that you're repaying, and the ending loan balance at the end of each monthly payment. So if we're going to use the same data from Bankrate, we can actually download this amortization schedule as a CSV file directly from the calculator on their website. And we downloaded a schedule at 4.25%, where our first monthly payment was $1,475. And you can see that in month one, we pay $1,475, and the overwhelming majority actually goes to interest. Over $1,000 of that monthly payment goes straight to interest, and only $413 goes to repay the principal. So we started with $300,000, and at the end of month one, we have really only shaved a few $100s off. We're at $299,586. In month two, you can see, illustrating this concept of the interest rate accruing off of a smaller amount. Instead of charging 4.25% on $300,000, they're now charging 4.25% on $299,586, the principal balance at the end of the previous month. That means that less interest is accruing. Instead of the $1,062 before, it's now $1,061. And that means, since we're making the payment, that a larger portion is going to go to the principal. Instead of $413, it's now $414. This is incremental at the start of the loan, but the deeper you get into the repayment period, more and more of that payment is going to go to the principal. Now, if we switch to the amortization table for the 4% loan, you can see that the monthly payment is lower because it takes less money to pay off the loan by the end of the 30 years if we're doing so at a lower interest rate. But even though we have a lower payment, the lower interest rate means that a larger portion of the principal is being covered from the very first month. With the 4.25 loan, only $413 went to the principal in month one. With 4% as the loan interest rate, $432 goes to the principal. And this gap will only widen with time, and eventually you'll be able to find the month in the schedule where the break-even point makes the cost of buying down your rate worth it to you. Now, these are the two variables that I think are most worth considering when it comes to deciding whether to use discount points. But there are other scenarios as well. Things aren't as black and white as the time value of money and the break-even point. You know, even if you plan to leave and sell that home before you break even, there's the possibility that you just prefer the lower payment that comes with a discounted mortgage, even if it means you paying an upfront sum. You could have other expenses that have less wiggle room, and maybe you want to make sure that your monthly payment allows you to have a budget that stays balanced. Remember, nothing happens in a vacuum, and anything you do in one area of your finances is likely going to impact other areas as well. There are people who have significant debts who have the possibility that they have to buy down their mortgage to get within the allowable debt to income range that their lender will approve for their loan. So in that scenario, the break-even point is irrelevant because they wouldn't get approved for a home loan in the first place with the higher rate and that higher payment. So at the end of the day, it's up to you to use this knowledge and determine which of these factors are most pressing in deciding whether you should utilize these discount points. But I wanted to make sure you had that knowledge in the first place as you pursue home ownership or the next phase in your home ownership journey. And hopefully this little video helped along that end. Once again, my name is Brenton Harrison with New Money, New Problems. If you haven't already, please subscribe to the channel and subscribe to notifications so you know when new videos are going to be posted, and we'll keep bringing them to you as quickly as we can. See you soon.